Should I lock my variable rate mortgage to a fixed rate? If so, when is the best time to do it? Today, we'll look at the facts. We'll also look at historical data from the Bank of Canada, Canada Mortgage and Housing Corporation or CMHC, and bank rates. At the end of this video, I hope to give you a better perspective on your mortgages. Hi, my name is Lei Villar-Cisneros with Homes by Lei and Right at Home Realty. I have over 20 years of combined real estate and mortgage experience, and I can help you with your real estate needs. Let's get started. Historically speaking, variable rates outperform fixed rates. The average fixed rate over the last 25 years, which is also the maximum amortization you can avail if you have less than 20% down or equity, is about 5.65%, while the average for variable rate is about 4.38%. If you started your mortgage 25 years ago and just renewed it every term, that's 1.27% difference savings, keeping the variable rate mortgage. While past rate savings is not guaranteed to duplicate the same savings in the future, it's good to know that if you stayed in the variable rate mortgage and can withstand the stress of fluctuations, that you might actually still be winning. Each mortgage and your situation is unique, so contact us if you need help with your mortgage, even if you just have questions. There are factors that you need to consider when you're locking your variable rate to fixed rate. Number 1, remaining term. Have you just started on your mortgage or are you almost at maturity date? If you just started and you want to lock into your fixed rate, you have to consider if you have plans of breaking the mortgage. You break the mortgage when you did not complete the term, say 5 years, 3 years, whatever that may be. This can happen when you refinance or sold your home as a result of job loss, divorce, bankruptcy, etc. So that brings us to number 2, penalty charges. There are penalty charges for breaking a mortgage. For typical variable rate mortgages, the penalty is typically about 3 months interest, while a fixed rate, depending on the lender, can range from a few thousands to $10,000 or even $20,000. While locking from variable to fixed rate may be free, always be mindful that breaking a fixed rate can cost you a fortune. Personally speaking, I broke my contract in 2007 when a prime rate went to 3% and it costed me about $11,000. But I saved a lot of money even doing so. I haven't switched to a fixed rate since, but as I say, your situation is unique. So if you're not sure, contact me for a free mortgage evaluation. Statistics say that homeowners tend to break mortgage on their 3rd year, between 3 years and 6 months and 3 years and 8 months. So if you just started on this, think about this first. Number 3, discount on the prime. Is your mortgage prime minus 1, prime plus 1, etc.? So check out your latest statement as well as the mortgage commitment that you signed. In this video, we'll look at this and how discount affects your savings. Number 4, this is very important. Are you on a tight budget? If you're barely making the payments on the current terms, then definitely go and lock your fixed rate now. While there are savings in keeping the variable rate, if you have no buffer, then it will drive you nuts and cost you sleepless nights. So for example, for $100,000 mortgage, the difference in the mortgage payment is $50 per month, which is $600 annually. If you have $500,000 mortgage, that's $3,000 a year or $15,000 for the full term. Now let's run a few scenarios to see if this is for you. For this demo, we'll do the following assumption. Prime rate is at current value of 3.2%. Fixed rate at 3.99, which is the current rate, give or take. Let's also assume that you just closed on your mortgage term of 5 years, which is the most popular term for most homeowners and first-time home buyers. Let's do the math. First scenario, rate comparison between variable rate of prime minus 1%. So let's assume a principal of $100,000. If your mortgage is $500,000, so you just simply multiply the result by 5. So for most home buyers that has a down payment or equity that is below 20%, the amortization maximum is 25 years, which is equivalent to 300 months. So we'll take the first scenario, which is prime minus 1. So we said that the prime rate right now, current prime rate is 3.2%, and we will take a scenario of prime minus 1. So 3.2 minus 1% is 2.2%. We will assume a 3.99 fixed rate, which is the current fixed rate, give or take. And we said we will take 300 months or 25-year amortization, and we will also calculate for those with down payment or equity that is over 20%. They have the option to do a 30-year amortization or 360 months. So we will have a 5-year term, which is the most popular term for most homeowners. So putting this factor, we will have a monthly payment of $433.16. So for a fixed rate of 3.99, the monthly payment is $525.48. So getting the difference of this, you will have a savings of 92.31 for the month. Multiply that by 12, we get roughly 1100 of savings in a year. So for year 2, year 3, year 4, and year 5, let's assume that the prime rate keeps on going up. So for year 2, let's say that the prime rate went up by 1%. So that turns into 4.2%, and our rate is prime minus 1, so we have our rate as 3.2. We'll keep the 3.99 fixed rate, same computations, and monthly payment will be up by $50. So for every $100,000 and a 1% difference, that will bring our payment to $50. So if you have 500,000 mortgage, multiply that by $50, that will be the mortgage adjustment for you every month. Now the fixed rate, as we say, is the same. So at this scenario, you would still have saved roughly $42. So over the year, it will be about $500. So if we keep on just staying with the same mortgage, we didn't touch anything, at the end of 5-year term, you would still have saved roughly $1,100, even if you lost in the final years. And this is taking in consideration that you just started your mortgage. So if the term of your mortgage is you're already on year 2 or your year 3 or almost at the end of your mortgage, then you would still have saved more because the rate has just changed recently. Now, if you had a 30-year amortization, that means you have longer mortgage life and you are paying a lower mortgage payment, but still at the end of the term, you would have saved $1,137. So if your prime rate discount, if your discount with the prime is prime minus 75, so your rate will be higher at 2.45 for year 1. You would still have saved $80 in a month or $959.98 for the year. So assuming that the same rate, prime rate goes up in the same way, then and we kept the mortgage and we just left it there, even if it went up and down, you would still have saved $296.25. Now, if we take prime minus 65, so at this point you will see that the savings has gone down. So if you keep your mortgage at prime minus 65 for the duration of 5 years, you would have lost $27 at the end of your mortgage, which is not bad. So I would say that for this scenario, your break-even point is roughly around prime minus 67 or prime minus 68. So let's say we move further, and let's say that your discount is 50 basis point or prime minus 0.5. So that means that on the third year you would start losing money, and you would have lost $516 at the end of the term. So if you're already on year 3 and this is your rate, so I would say to keep it, because at this point you would have still saved money. Now, if you're just starting the term, that means that when the prime rate goes over 5%, then it's time for you to keep your mortgage. But even at this point, your rate would still be like just 4.35. The Bank of Canada policy rate influences the short-term interest rate, such as the prime rate, by adjusting its target overnight rate on 8 special dates of each year. The policy rate is used to control inflation from rising above their target and protecting us from recession. This has a domino effect on so many things. When the policy rate goes up and the short-term rate goes up, the prime rate will go up, leading to the variable rates to go up as well. Let's look at the policy interest rate history for the last 25 years. If you see, it was always high until 2001 when it starts declining, marked in red. It stayed at 0.25% for 2 years since March 2020, and now at 1%. Now let's look at the prime rate history for the same period. If you notice, prime rate is actually at 3.95% pre-pandemic and then stayed at 2.45 for the last 2 years before it moved in March and April, which is currently 3.20%. Also notice that the prime rate is roughly about 2 to 2.5% above the policy rate, and it's been about 2.2% for a few years. We are currently on the 3rd scheduled date, so we expect another 5 rate announcements until the end of the year. Now let's assume that it will steadily increase 25 basis points for all of the 5 dates at worst case scenario, so that will bring the policy rate to 2.25%. So the prime rate will be somewhere about 4.45%. With that in mind, let's see how this affects our mortgage. For our example, we'll move the prime rate up to 5.5%, which is over the current benchmark rate. We'll talk about benchmark rate on another video. I hope that this helped you, and if you have questions, contact me. My name is Lei Villar-Cisneros with Homes by Lei, and as always, at Homes by Lei, we'll make your real estate dreams come home.